right now. Something big is happening with American money, and most people have no idea. $75 billion. That is how much money Americans have pulled out of the stock market in just 6 months. 52 billion of that left in just the first 2 months of 2026. That is the biggest stock market exit in over 16 years. So the question is, where is all that money going? Is the stock market about to crash? Are smart investors seeing something you don't? Should you be moving your money right now? Here is what is wild. Your neighbor might already be doing this. Your co-worker might already be doing this. Wall Street insiders are definitely doing this. And if you don't understand why this is happening, you could be left behind when the dust settles. So, stay with me, because in the next 20 minutes, I'm going to break down exactly why this is happening, where that money is actually going, what the ultra-rich are quietly buying instead, and, most importantly, what you should actually do about it. Don't skip this, because some of the numbers I'm sharing today, your financial advisor probably has not told you yet. Let's go. But before we dive in, let me take just a quick moment for those of you who are new here. My name is Sohail Balkhi. I am an entrepreneur, and I run a small IT company that provides business solutions to customers right here in the United States. Over my career, I have worked as a consultant for some of the biggest companies in the world. Companies like IBM, HP, the state of Florida, Black & Decker, and TracFone Wireless. I have spent decades at the intersection of business, technology, and finance. And what I have learned from working with major corporations is this: the way money moves at the top always ends up affecting everyone at the bottom. That is why I created this channel, Vectorlog. This is your home for real, straight talk updates on day-to-day finance, business trends, and the financial news that actually matters to your wallet. No fluff, no hype, just the facts. If that sounds like something you need, hit that subscribe button right now. We drop new content regularly, and I promise you will not regret it. All right, now, let's get into why Americans are running from the stock market in 2026. Let's start with the numbers, because this is not a theory. This is not a prediction. This is already happening. US investors have pulled $75 billion out of the stock market in just the past 6 months. 52 billion of that left in just January and February of 2026. The largest outflow recorded since at least 2010. Let that sink in. The largest stock market outflow in over 16 years. Now here is the confusing part. On the surface, the stock market looked fine coming into 2026. The S&P 500 had hit record highs. Corporate earnings were growing. Consumer spending was solid. So why are people leaving? The answer is not simple. It is actually 5 different forces, all happening at the same time. Think of it this way. Imagine 5 storms forming at once. Each one on its own might not cause a disaster, but when they all hit together, people start heading for shelter.
And that is exactly what smart money is doing right now. heading for shelter. Let me walk you through each of these 5 forces, one by one. Reason number 1: trade policy uncertainty. Since President Trump returned to office, tariff policies have created a wave of unpredictability for businesses. When a company does not know what its costs will be 6 months from now, because tariffs could change overnight, it becomes very hard to predict profits. And what do investors hate more than anything? Uncertainty. When you cannot predict earnings, you cannot confidently value a stock. And when you cannot confidently value a stock, the smart move is often to step back. This is one major reason big institutional investors, the ones managing billions of dollars, have been reducing their US stock exposure. And when the big money moves, it creates a ripple effect. Everyday people feel the volatility. They see red in their portfolios, and they start asking themselves, is this still worth it? Reason number 2: geopolitical risk. Right now, a military conflict involving Iran has pushed energy prices significantly higher and disrupted global trade routes. Higher oil prices mean higher costs for shipping, for manufacturing, for transportation. All of that eats directly into company profits. Now, financial experts will tell you, geopolitical events are usually short-term. The market typically recovers once the conflict ends. But here's the big problem. Nobody knows when it ends. And that uncertainty costs money. The S&P 500 came close to a 10% decline from its January all-time high before recovering. That kind of swing is exactly what shakes nervous investors loose. Reason number 3: inflation is coming back. Remember 2022? Inflation hit 40-year highs. The Federal Reserve raised interest rates aggressively. Stocks fell more than 20%. It was brutal for investors. Well, many economists are worried that 2026 is starting to look a lot like 2022. Inflation risk is rising again. Interest rates are moving. And here is the really concerning part. Even gold and treasury bonds have been moving lower, together with stocks. Normally, when stocks fall, bonds go up. They act as a safe place to hide. But when both move lower at the same time, investors panic, because there is nowhere safe to go inside traditional investments. Cash starts looking like the only option. And I will show you exactly where people are putting that cash in just a moment. Reason number 4, and this one is fascinating. AI reality is starting to catch up with AI hype. For the past 3 years, the stock market's biggest gains came from a small group of AI companies. Nvidia, Microsoft, Google, Meta. They drove most of the S&P 500's returns. But now, investors are asking hard questions. Is all this AI spending actually generating real profits? Are these valuations justified? How long before competitors catch up? Concerns about the risks and costs of AI have started to reduce the appeal of big tech stocks. When the sector that was carrying the entire market starts to wobble, the whole index feels it. And the 5th force, this one is huge. The weakening US dollar. 2025 was the worst year for the US dollar in about a decade. And in 2026, that trend has not reversed. A weaker dollar erodes the real value of US assets for international investors, which drives global capital out of US markets. And here is something even more alarming. This is happening even though a weaker dollar should make it more expensive for Americans to buy foreign assets. But Americans are choosing to diversify internationally anyway. simply because they are losing confidence in the US market. International markets in Europe, Japan, India, and Southeast Asia have started attracting capital that used to flow automatically into the US. When even American investors stop automatically trusting American stocks, that is a very significant signal. All right, so we know why money is leaving the stock market. Now let's answer the question everyone actually wants answered. Where is all that money going? Because here's the thing. Money doesn't just disappear. It always goes somewhere. And understanding where smart money flows is one of the most powerful tools you have as an investor. Let me walk you through the 4 main destinations. Destination number 1, money market funds. As of February 2026, there is approximately $8.25 trillion sitting in money market funds, a brand new all-time record high. That is up from just $5 trillion back in 2022. Money market funds are essentially high-yield cash accounts. They are not exciting, but right now they are paying decent interest rates, and they feel safe. Here is the honest truth, though. While sitting in cash feels safe, history shows it is usually a mistake long-term. An investor who stayed in the S&P 500 since 2022, despite all the crashes and volatility, would have earned 42% in returns. The money market fund over that same period, 18%. Cash is safe in a storm, but storms don't last forever. Destination number 2, gold. Gold recently topped $4,300 per ounce, a record high. Why gold? Because it thrives in exactly the environment we have right now. Economic uncertainty, inflation fears, dollar weakness, geopolitical conflict. Gold doesn't pay dividends. It doesn't generate income, but it holds value when everything else is falling. Major financial institutions like State Street and PIMCO are actively recommending gold right now, calling it a strategic hedge against debt and currency debasement. Most advisors suggest keeping 5 to 10% of your portfolio in gold-related assets, whether that is physical gold, gold ETFs, or gold mining stocks. Destination number 3, real estate. High net worth investors are moving money into real estate because it does 2 things that stocks often can't. It generates income, and it appreciates during inflationary periods. When inflation pushes up the cost of materials and land, property values often climb right along with it, and rental income provides cash flow that adjusts with inflation. Now, you do not need to buy a building to get real estate exposure. REITs, real estate investment. Let everyday investors participate in commercial real estate through the stock market, starting with just a few $100s. No landlord headaches, no property management, no big down payment. Destination number 4, one that would have seemed shocking 5 years ago. Bitcoin. For the first time, ultra-high net worth investors are talking about Bitcoin, not just as speculation, but as a legitimate alternative asset, a digital store of value, similar to gold. Bitcoin reached an all-time high of around $126,000 in late 2025, before pulling back to around $85,000. Even at current levels, many sophisticated investors still view it as a long-term hedge against currency debasement. That said, Bitcoin is volatile. It is not for everyone. Financial experts recommend keeping any crypto allocation very small, no more than 5% of your total portfolio. Only invest what you can afford to lose completely. So here is the moment everyone has been waiting for. With all of this happening, what should you actually do? I'm going to give you 4 practical takeaways. And I want to be very clear. This is not financial advice. I am not a licensed financial advisor. Always consult a professional before making major financial decisions. But these are the principles that smart money is following right now. Takeaway number 1. Do not panic sell. The biggest mistake investors make is selling after the market has already dropped. History is very clear about this. Investors who panic and exit during corrections consistently underperform those who stayed the course. If you have a long-term investment strategy, a correction is not a reason to abandon it. The people who got hurt most in every past crash were the ones who sold at the bottom and missed the recovery. Don't be that person. Takeaway number 2. Diversify now. If 100% of your investable money is in US stocks, this is your wake-up call. Consider spreading your exposure across US stocks, international stocks, bonds, real estate through REITs, and a small allocation to gold. Diversification doesn't prevent losses, but it prevents catastrophic losses. Different assets move differently. That is the whole point. You don't need to do everything at once. Even small steps toward diversification can make a big difference over time. Takeaway number 3. Build your emergency cash cushion. With money market funds paying decent interest right now, there has never been a better time to make sure your emergency fund is fully loaded. 3 to 6 months of living expenses, sitting in a high-yield savings account or money market fund. This is your financial shock absorber. If the market crashes, you will not be forced to sell your investments at a loss just to pay your bills. This one step alone has saved countless families from financial disaster during downturns. Takeaway number 4. Stay informed, keep learning. The investors who win long-term are not the ones who make the most dramatic moves. They are the ones who understand what is happening and make calm, educated decisions. Knowledge is the best investment you can make right now. And that is exactly why this channel exists, to help you cut through the noise and stay informed. Let me bring it all together. In 2026, Americans are moving money out of the stock market at the fastest pace in 16 years. Driven by 5 powerful forces: trade uncertainty, geopolitical conflict, inflation fears, AI valuation concerns, and a weakening US dollar. That money is flowing into money market funds, now sitting at a record $8.25 trillion. Gold, which just hit $4,300 an ounce. Real estate through REITs, and to a smaller degree, Bitcoin and digital assets. The smart move is not to panic. The smart move is to diversify, protect your cash cushion, and stay educated about where the economy is heading. And that is exactly the conversation we have every single week, right here on Vectorlog. Now here is where I need your help. I read every single comment on this channel. Every single one. So here's what I want you to do right now. Drop a comment below and tell me what financial topic is keeping you up at night in 2026. Is it inflation? Is it your retirement account? The housing market? Credit card debt? Social Security? Whatever is on your mind, type it in the comments right now. Your comment does 2 very important things. It tells me what to cover next, content that is made specifically for you. And it helps this channel grow, so we can reach more people who need this information. If you got value from this video, please hit the like button. It takes 2 seconds, and it helps this video reach more people who need to hear this. And if you are not subscribed yet, subscribe right now. Hit that notification bell, so you never miss an update. Because at Vectorlog, we don't wait for your financial advisor to tell you what's happening. We tell you first.